Hey everybody, it's John King with Summit Funding, and it is July of 2023, halfway through the year. And I want to give you a market update. For a lot of you, you're getting this via email through the HomeBot portal. So hopefully you're enjoying your monthly HomeBot digest and updates. And I want to kind of supplement that periodically with a market update and kind of fill you in on what's going on and what's important to know as a homeowner. So first of all, for the last year and a half, inflation has been the biggest thorn in our side. Inflation has skyrocketed, and that slowed down the market when it comes to home buying, and prices taken off significantly has been curtailed simply because the Fed has raised interest rates. And so a lot of people were concerned and saying, hey, John, this means that the housing market's going to crash. Well, we haven't seen it crash at all. We haven't even seen really a drop much at all. Here's why. Because there are still not enough homes for the number of people that want to buy them. So as a homeowner, you're in a great position as long as you're happy with your home. The problem is that if you've outgrown that home, what are you going to do? You've probably got a super low interest rate, 2.5%, 3% rate. Rates right now are pushing 6.5% to 7%, and it's staying pretty persistently high. Why is it staying persistently high? Well, we expected by now that inflation would start to come down. And this morning, the inflation report came in and inflation's down to 3%. It was upwards of 8 or 9% a year ago, but the Fed wants to see it at 2%. And that last little bit, that last mile is the hardest mile. And so I think we're kind of going to be stuck in this range of interest rates between maybe 5.9-ish to 6.9. Maybe a little below that, 5 3/4, but then we're going to be maybe a little higher than that, all the way up to 7.25. The bottom line is the range of interest rates. I don't think we're going to see a big change until maybe next summer. We're 12 to 18 months away. What does that mean for you? Well, the first thing I'm worried about is your credit card debt. Hopefully, I'm not talking about you, but the average American's credit card debt has ballooned in the last 2 years, and it's creating major stress on people's budgets. And so if you're in that position where you've got a lot of credit card debt, you need to touch base with me. Now, a lot of people a year ago opened up home equity lines of credit. I thought home equity lines of credit were a great idea a year ago, but I also thought rates were going to come back down sooner, and they're not. So with the persistence of high interest rates, what you're seeing is your home equity line of credit, it's going up to sometimes 8, 9, 10, 11% interest. I have a client recently that I started a refinance for them. As a matter of fact, 2 of them recently that I did refinances for, where they had 3% interest rates. And we refinanced them to a 6.5% rate, but it's because they had a home equity line of credit at 10. They had a bunch of credit cards that were at 20 and 25%, because your credit card rates have been going up as well. So you need to be aware of how much you're spending in total interest. So both of these people each saved upwards of $1,000 a month off their monthly payment, and it made it so that all of their debt was tax deductible. Instead of having high interest credit card, not being able to write it off, and it makes it easier to refinance down the road. Because when you refinance later, we're simply refinancing what you owe, which is not as high of a risk. When you pull cash out of your home, it's considered a higher risk loan than if you're simply refinancing what you owe. So Fannie Mae and Freddie Mac, who set the rules, earlier this year, they bumped the cost of a cash out refinance compared to a refinance to pay off simply the mortgage that you have on the home. So why do you want to pull cash out when rates are lower and pay a higher rate then? Because that's the loan you're going to keep for a longer period of time. Instead, what you really want to do is you want to refinance now, take the hit, pay the higher interest rate that it takes to pull cash out right now. Matter of fact, a lot of people are doing FHA for their cash out refinances because FHA is not as big of a hit, but it has mortgage insurance. But FHA allows you to save, either option, when you consolidate, allows you to save a whole bunch off of your monthly payment, and it allows you to get a better interest rate later when you're simply paying off your mortgage instead of the premium or the bump you're going to pay an interest rate later when you refinance to pay off both your current mortgage and your credit cards and wrap it all in at that time. So I'm not saying treat your home as an ATM machine. I think it's critical to make smart financial decisions. But I think that a smart financial decision sometimes is not to bury your head in the sand and get so backed up with your total monthly debt that you end up falling behind and it ruins your credit. I'm going to shift gears super quick. As a homeowner, I think it's important for me to remind you that you need to have a living trust. Now, a lot of people say, John, I don't have any assets. You own a home. You need to have a living trust because estate planning is critical when it's too late. Because if you don't have an estate plan, that means the court gets to decide and your property has to go through probate. And that's a expensive and time-consuming process. You may not be around, but the people you love who are still around, they care. They're going to have to deal with the burden. And so I want to just remind you, if you don't have a living trust, you need to get one. Now, if you don't know who to go to, give me a call. I'll connect you with some amazing people. You can get a living trust for as cheap as $500 or $600 to as expensive as $2,000 or $3,000. Depends on what level of advice and consultation that you need. But you need to think about your estate planning before it's too late. You need to think about things like having a power of attorney so that if something happens to you without you passing away, the power of attorney allows somebody else to make financial decisions for you. Now, the power of attorney doesn't help you doesn't help your family after you're gone. That's where the living trust helps. The power of attorney is critical if you were hurt and you can't make financial decisions for yourself, just like a medical power of attorney allows somebody to make medical decisions for you. Now, why am I talking about all of this? Because the truth is, I feel like it's my obligation to remind you of some things that you might not otherwise be thinking about. My family's had some things come up. I've seen lots of clients and friends have things come up. And it's just a reminder that life moves very, very quickly. And we get busy every single day on things that we think are important. And we forget about the things that are not urgent. We're focused on too many things. And we worry about, oh, I'll handle my estate plan later, or I don't have enough assets. If you own a home or if you have children, you really should have a living trust. Well, hey, thanks for listening to me. If you have any questions about buying a home, we can talk about that. It's a good market if you need to sell your home. It's a hard market if you're looking to buy, because if you're in a position of wanting to buy a home, you're in competition with a lot of buyers, and you're going to be in more competition down the road. Because when interest rates come back down, all those buyers that have been sitting on the sidelines saying, I'm out, I can't afford to make a payment at these high rates, or I'm not willing to make the payment at these high rates, they're jumping back in. That's going to be great for you on the sale of your home, but it's going to be horrible for you on the purchase of the next home. So if you're thinking about trading out your home, recognize if you wait, you might be able to get rates back in the 4s. You're not going to get them back in the 2s, but you're going to pay a lot more for the home. And so look at what your tax consequences are. Look at how much you've gained in equity in your home so far, because you may be best off selling now, having the ability to not pay capital gains if it's been your primary home long enough and you have under the limit of the gain. I'm not going to go into that because you need to talk to your tax guy about. But the bottom line is, it is critical to be thinking about that now and not just waiting and closing your eyes and hoping things are going to get better later. Yes, if you wait, your house price will go up, but so will the price of the house you're going to buy. In California, your property taxes are tied to what you bought the house for. If you buy now, you're going to have lower property taxes longer, and you can always refinance later to lower your interest rate. Thanks for listening. If you have any questions, give me a holler. Hope you're enjoying your summer, and we'll talk to you soon. Bye-bye.